Have you ever really thought about what happens when you apply for a credit card or a mortgage? It kind of feels like a black box, right? Well, it's not magic. It's this incredibly complex world of prediction and numbers called credit risk, and it's a system that touches pretty much every part of our financial lives. So today, we are going to pull back that curtain.
So, let's just start with the question that really matters to all of us. When a bank gets your application, what are they actually seeing? How do they take all your personal details and boil them down to a simple yes or no?
Well, it often starts with something that looks like this, a scorecard. And this is where it gets kind of fascinating. They quantify a person. Look, our sample applicant is 32 years old. Okay, that gets them 120 points. Their salary is in a certain bracket. That's another 160. All in, their total comes to 460 points. But as you can see, the cutoff for getting approved is 500. So the decision is automatic. Refuse credit. At this level, it's really just a numbers game.
But that personal scorecard, that's just the very beginning. In this explainer, we're going to zoom out from your individual score to see the massive risk problem that banks are dealing with every single day. Then we'll look at the global rulebook they have to follow. We'll break down the key ingredients they use to predict who might default. And finally, we'll see how they even know if their predictions are any good in the first place.
Okay, so let's start there with your personal score. To you, it feels like the whole story, right? But in reality, it's just the tip of this giant, mostly hidden iceberg.
And that's because your bank isn't just worried about your loan. It's managing a massive portfolio of maybe millions of loans, all at the same time. Your personal risk is just one tiny piece of a huge, constantly changing financial puzzle.
And that really gets us to the true scale of the banking risk problem. It's the leap from worrying about one person not paying their loan to the terrifying possibility of thousands of people defaulting all at once.
To deal with this, there are major international rules in place. And one of the biggest is this crucial safety net. Banks are required to hold a financial cushion. They call it capital. That's more than 8% of their risk-weighted assets. Now, risk-weighted is the key phrase there. A safe mortgage doesn't weigh as much as a risky corporate loan. And this whole system forces banks to set aside more of their own money to cover their riskiest bets. It's, a fundamental rule of modern banking.
And this is the perfect way to think about it. That capital is basically a giant shock absorber for the entire financial system. So if a huge wave of defaults suddenly hits, this is the cushion that's supposed to protect your savings and stop the bank from going under.
So how do banks figure out exactly how big that shock absorber needs to be? Well, to make sure banks all over the world are playing by the same safety rules, they follow a really detailed global rulebook. The version that really shaped all this is called Basel II.
Now, Basel II is built on what they call 3 pillars. Pillar 1 is the nitty-gritty. It has the actual formulas for calculating risk. It's the how-to guide. Pillar 2 is about supervision, making sure regulators are checking the bank's homework so they don't cheat. And Pillar 3 is about transparency, forcing banks to publicly report their risks. We're going to focus on Pillar 1 because that's really the engine room of the whole thing.
Which, of course, brings us to the biggest question of all. How on earth do you measure something that's so fundamentally unpredictable? How do you put a hard number on the future risk of millions of different people and companies?
Well, the way they do it is by breaking it down into 3 core ingredients. And these 3 little acronyms, PD, LGD, and EAD, are the absolute bedrock of all modern credit risk modeling.
So first up, you've got PD, which stands for probability of default. It's pretty much exactly what it sounds like. What are the odds that this specific person or company is going to default in the next year? Is it a 1 in 100 chance, a 1 in 10 chance? That's the first piece of the puzzle.
Next up is LGD, or loss given default. This is so important, because if someone defaults, the bank doesn't always lose 100% of the money, right? They might repossess a house and sell it, or get something back through collections. LGD is the percentage of the loan the bank figures it will actually lose for good.
And finally, there's EAD, exposure at default. This one's simple, but you can't forget it. It's just the total amount of money that's on the line when the default happens. For a normal loan, that's just the balance left. But think about a credit card. It could be the entire credit limit, even if you haven't spent it all yet.
Okay, so now let's see how they put it all together. You literally just multiply them. The probability of it happening times the percentage you'll lose if it does, times the total amount you have on the line. And this simple little formula gives the bank its expected loss, the average loss they can plan for, almost like a regular cost of doing business.
But, making a prediction is one thing. Knowing if that prediction is any good is something else entirely.
And that's why testing and validating these models is every bit as important as building them in the first place. One of the biggest dangers they face is a problem called overfitting. So on the left, you see a model that's doing what it's supposed to do. It's learning the general pattern from past data. But look at the one on the right. That model has basically just memorized the past, including all the random noise and weird flukes. An overfitted model is terrible at predicting the future, because the future never looks exactly like the past.
So to make sure that's not happening, banks are constantly backtesting their models, and they often use a really simple traffic light system. They're always comparing what the model predicted would happen with what actually happened. Green light means everything's good, the model's working. Yellow is a heads up, an early warning that performance is slipping. And a red light? Well, that means you've got a serious problem. The model is broken, and you can't trust it anymore.
But it's not enough to know if your model works when the economy is good and the sun is shining. The official rules, and you can see the actual text from the Basel Agreement right here, they demand that banks prepare for the storms. They have to plan for future economic shocks. And this process is called stress testing. Honestly, the best way to think about it is like a financial fire drill. Banks create these simulations of really bad but still believable crises, like a housing market crash or a huge spike in unemployment. Then they run all the numbers to see if their capital shock absorber is actually big enough to handle the disaster.
Whew, okay. So we've gone from a personal scorecard all the way to global regulations and these intense financial fire drills. Let's bring it all back home. What does this ridiculously complex system actually mean for you and your money?
Here's the bottom line. This whole system is what directly determines the interest rate you're going to pay and whether you get approved for a loan in the first place. But on a much bigger scale, when it's all working the way it should, it acts as a guardrail for the entire economy. It's designed to prevent banks from failing, to protect our savings, and to try and keep the whole system stable.
And all of that leaves us with one last really big question. This entire global system is built on one core belief, that you can predict the future by studying the past. But what happens when a crisis comes along that looks nothing like anything that's ever happened before? What happens when the future decides not to follow the old rules? That, right there, is the billion-dollar question at the very heart of credit risk.